Welcome to the second Emerging Manager Symposium hosted by the Los Angeles City Employees Retirement System, LACERS. My name is Cynthia Ruiz, and I am the president of the LACERS board. We are a 7-member board, and today you're going to hear from 2 of our members. That's how important this issue is to us. LACERS is a pension fund with over $22 billion in assets. So we want to provide opportunities to a diverse group of managers. Our first Emerging Manager Symposium held last year was so successful, we decided to do another one. And after receiving feedback from the audience, we have structured today's agenda so you can take away valuable information, which hopefully gives you a path forward to develop a relationship with us. Now, I'm so excited because we had over 400 people register for today's event. Now, every initiative needs a champion, and the champion of our Emerging Manager program has been Commissioner Nilza Serrano, who has served on the board for the past decade. Let's welcome Commissioner Serrano.
Thank you, Cynthia. A decade, wow. Good morning, my name is Nilza Serrano, and this is our second Emerging Manager Symposium, and we're excited about the presentation and discussions on today's agenda. LACERS is a multi-billion-dollar defined benefit public pension plan that administers the retirement benefits of over 47,000 retirees, beneficiaries, and current employees of the city of Los Angeles. LACERS seeks to cast the widest net in search of the best investment managers in the industry. Part of fulfilling that objective includes finding and working with emerging managers that are often overlooked and who are hidden gems among the thousands of investment firms. LACERS trustees, staff, and consultants are committed to solving the challenge faced by emerging managers. We understand that building relationships with prospective institutional investors like LACERS can be difficult. Therefore, the Board of Administration and the staff are working tirelessly to amend investment policies and processes to build a reputation as a recognized leader among the handful of elite emerging manager programs. LACERS seeks to build a bridge between your firm and our staff and consultants. Today's Emerging Manager Symposium is designed to narrow the gap, to bring you steps closer to better understanding the manager selection process, and to allow you to complete on the level playing field. I encourage you to stay the second hour. Today's program for our Fireside Chat featuring Mariam Rivera of Ulu Ventures, one of our LACERS newest investment managers, joined by fellow LACERS board Commissioner Elizabeth Lee, who will be moderating the discussion. We hope you find the next several hours to be helpful, informative, as you hear from LACERS staff and its consultants explain more about our emerging manager selection process. We hope that your firm will be poised to manage capital on our behalf of LACERS. May I ask you to please sign in or sign up at our RFP portal on our website for any upcoming RFPs, releases. Check off every box and encourage all your colleagues to do the same. On behalf of the trustees, we wish you much success. And now back to Rod, I think. Rod?
Okay. Thank you, Commissioner Serrano. And good morning to all of you, or good afternoon to wherever you are. Again, welcome to the LACERS Symposium. For those of you who do not know me, I am Rod June. I am the LACERS CIO, and I'm your lead point of contact if you are an emerging manager. I am excited to welcome you here today and truly want to get to know you better in the future. Before we begin the program, let me briefly describe the structure for today. which is divided into three distinct segments. First, the Emerging Manager Public Markets Program. Second, the Emerging Manager first is the Public Markets Program. Second, the Emerging Manager Private Markets Program. And finally, our Fireside Chat. In order to supplement what you hear and see at today's Emerging Manager Symposium, I kindly ask that you visit LACERS.org to visit our new Emerging Managers Resources page. It contains links to informative YouTube videos explaining LACERS Emerging Manager Program, as well as the asset allocation process. I also encourage you to sign up for the LACERS RFP subscription service, as mentioned by Commissioner Serrano, to let you know when there is a release of any investment RFP or RFI. Okay, let's get started. I am pleased to provide the State of LACERS Emerging Manager Program report. To better understand where we are today, we need to go back nearly 20 years ago when LACERS first carved a path and built an internal culture of working with emerging managers. LACERS started its carve-out program with a little over $200 million that was specifically earmarked for small and emerging investment managers. This program spanned from 2003 to 2010. Thereafter, LACERS took a pause for about a year to analyze our past EM efforts and how we could improve our progress and relationship building with EMs. In 2012, we relaunched a new and improved LACERS EM program, started slowly, but continually increasing the number of EMs on our roster, as depicted in this bar chart. As you can see, growth has been consistent since 2013, and we now count over 30 EMs on the LACERS roster. Moving on to the next chart, LACERS also increased its total dollar exposure to EMs, as depicted in the bar chart diagram from 2013 to 2021. Since the restart of the program in 2012, LACERS has invested and committed over $900 million to EMs. For 2021, LACERS committed over $90 million to EMs, private equity funds, but we are still looking for possible real estate opportunities as well. And for our public market equity and fixed income portfolios, the next manager search cycle begins in 2024. LACERS and its consultants will be working hard to broaden our reach to more EMs in the public market space. Moving on to the next slide, let's take a look at EM exposure on a percentage of dollar basis as depicted in this bar chart. I am proud to present a chart that reflects continual growth in the percentage of exposure. LACERS has approximately 4% of our capital situated with EMs. You will notice a slight dip in 2021, but that was largely due to the fast expansion of our total asset growth for that year. And by the way, it was LACERS' banner performance year in 2021 with a net return of 29.09%, ending June 30th of 2021. Nonetheless, we want to increase this exposure percentage going forward. Looking at the next slide, you can get a sense of the same exposures, but broken down by asset class level. They are color-coded, and you can see that there is a trend upward. And by policy, LACERS' expectation is to place no less than 10% of its capital with qualified emerging managers. The charts that we have just reviewed reflect satisfactory progress, but we are still short of our desired exposure to EMs. We believe that placing capital with EMs is a key and driving factor in helping LACERS meet its performance objectives. We are constantly reviewing our emerging investment manager policy and program and have made recent changes to embrace greater inclusivity of EMs and to engage in a more robust research to better understand how we can outreach better. We want to build portfolios consisting of the most qualified and proven managers in the industry, and that includes you, the emerging managers. We meet a number of existing and new emerging managers at many conferences and events. Staff virtually met with 70 EMs in 2021, and our 3 investment consultants meet with even more EMs. I continue to direct my investment staff to meet you both virtually and more recently and in the future in person. And I am encouraging our investment consultants to cast a wider net to capture more EMs in their respective programs. LACERS pays well over $1 billion in retirement and health benefits each year to its retirees and beneficiaries. We need the best investment managers on our team to help us deliver on these promises. We want your firm to compete, to be a member of our investment manager team, and help us drive our performance upward. I look forward to working with you in the future. Let me take this moment to thank the Board of Administration for being very supportive of LACERS Emerging Manager Program. Now, I am going to turn this symposium over to my investment staff and consultants, starting with Brian Fujita. Thank you.
Thank you, Rod, and good day to all of you. I'm Brian Fujita, Chief Operating Officer and Head of the Public Markets team. During the session, I'll be providing you with a brief overview of LACER's public market portfolio, LACER's emerging manager policy and manager selection process as they pertain to the public markets portfolio, as well as an update on current and anticipated searches. I'm also joined today by Carolyn Smith of Nepc, LACER's General Fund Consultant. She and her team assist LACERS with essential investment activities, including total fund asset allocation and public markets investment manager searches. Carolyn will be focusing her discussion today on Nepc's roles in LACERS emerging manager efforts. Upon the conclusion of Carolyn's presentation, I'll host a Q&A session to address some of the commonly asked questions about the LACERS Emerging Manager Program. Now, for those of you who haven't met us before, I'd also like to introduce the 4 other investment officers of the public markets team, beginning with Barbara Sandoval, who also is the coordinator of our very well-organized event today. Ellen Chen, who serves as LACERS ESG Risk Officer, Jeremiah Paras, and James Wang. Together, we oversee 5 public markets asset classes, including domestic equities, non-US equities, core fixed income, credit opportunities, and public real assets. The entire public markets portfolio is valued at approximately $18 billion and is diversified across 31 strategies and 24 investment managers. Now, I won't go into detail about what those strategies are or who those managers are, but if you're interested, you can refer to the performance reporting page on the LACERS website for more details. Okay, so now that you have some background on the public markets portfolio, I want to talk specifically about LACERS emerging manager policy and the selection process, beginning with how LACERS defines an emerging manager. Based on the LACERS policy, emerging manager status is primarily determined by the amount of assets under management a firm has. Generally speaking, a firm that manages less than $2 billion may qualify as an emerging manager, subject to a few other criteria that I'll discuss shortly. It's really important to note that the criteria based on diversity characteristics such as race and gender are not considerations in LACERS policy due to California procurement law, specifically Prop 209. But that being said, LACERS is very much interested in building relationships with diverse firms that can produce long-term risk-adjusted returns for the portfolio, all else being equal. Now, in addition to the AUM criteria, the LACERS emerging manager policy sets forth 5 other criteria to qualify as an emerging manager in LACERS manager searches. A firm has to have at least 50 billion in strategy assets under management. A firm must be in existence for at least 1 year. If the firm is a spin out of the majority of key senior professionals from another firm, then 6 months. Those time requirements are based on the firm's legal entity formation date. The portfolio manager or team must have at least a 5-year track record of managing the strategy, with 3 of those years being GIPS compliant. The firm must be majority owned by principals and or employees of the firm. And the last is not really a criteria, but more of a restriction on how much we can invest. LACERS may not fund more than 20% of the strategy AUM at the time of the firm's hire. So don't worry if you didn't catch all of those criteria. As Rod had mentioned, we have a very well put together emerging manager resource library on our website, and a summary of that criteria is posted there. So you're free to review that at any time. Now, moving on to the manager search and selection process, I wanted to provide you with a brief overview of how that works for the public markets portfolio. When we have the need to add investment strategies to the portfolio, LACERS is required to conduct open competitive bidding processes in compliance with public contracting and procurement law. So what this means is we're required to issue RFPs, which describe the scope of services and other requirements managers must meet to compete in searches. All qualified firms, emerging managers and non-emerging managers, are allowed to submit RFP responses. We don't issue searches solely dedicated to emerging managers or solely dedicated to non-emerging managers. Now, how does the policy criteria that I just discussed play into these searches? Basically, they modify some of the RFP minimum qualifications to give emerging managers a fair and equal opportunity to compete alongside more established managers. If you haven't competed in the LACERS RFP process and you're curious about the requirements and information we seek from managers, I highly recommend that you review some of our past RFPs, which can be found on our website in the RFP archive. Now, the entire RFP process is governed by the LACERS Manager Search and Selection Policy, also available on the website. And it involves LACERS board, investment committee, staff, and NEPC. In terms of responsibilities, staff and NEPC are responsible for evaluating the candidates and presenting recommendations to the investment committee and board. The investment committee is responsible for approving semifinalists in the search or further due diligence, and then interviewing those semifinalists after staff and NEPC conducted that due diligence. The committee is also responsible for recommending finalists to the board, and the board has the sole authority to award contracts to firms. Again, if you'd like more details on this process, you can review the policy that's posted on the website. We also have a brief summary of the process in the Emerging Manager Resource Library. Now, moving on to current searches and opportunities, we currently have 2 searches in progress, one for passive strategies and one for transition management services. The response periods for both of those searches have closed, and both of those searches are in the evaluation phase. As Rod had mentioned earlier, our next anticipated RFP cycle begins in 2024. However, that's not to say that we won't issue RFPs earlier than that. As circumstances change, our portfolio needs may change. So I'd like to conclude my discussion with some tips on how you can stay informed about potential opportunities to ensure that you don't miss them. And the first is something that Rod had mentioned earlier, is meet with us. If you don't currently have a relationship with us, you can email the lacers.invest@lacers.org email address, which is also found on the website, to set up a meeting. Secondly, Rod and Commissioner Serrano had mentioned this, is register for the RFP RFI subscription service. This is by far the best way to be notified directly of any RFPs that we issue to the market. Once you register for that service, you'll automatically get an email to the RFP link when they're published. Next, routinely review the RFP page on our website, as well as the LACERS website, to see what new postings are available. We'll always post our RFPs publicly on both of those websites. Additionally, we work with several emerging manager-focused organizations like the New America Alliance, National Association of Securities Professionals, and the Association of Asian American Investment Managers to have our RFPs advertised on their websites. So routinely check those websites as well. We also post ads in Emerging Manager Monthly and Pension and Investments. And then finally, follow us on LinkedIn. You can get a lot of news on events and opportunities through that, to that website. So with that, I'm going to turn the discussion over to Carolyn Smith of NEPC. So Carolyn, take it away.
Good morning, everyone. My name is Carolyn Smith, and I'm with NEPC. And I thought I'd spend just a brief minute sharing with you, and if you could turn to the next slide, some information about NEPC for those who are not familiar with NEPC. We are an independent investment consulting firm. We have about 400 clients that we work with. We've got employees located all over the country. The LACERS team is all located on the West Coast. We have 7 different practice teams that focus on client types. And as you'll see on the right-hand side of my slide, we have a pretty broad base of clients, but we know that the different client types have very specific needs. So there is a public fund practice that covers all of our public fund clients. And if you turn to the next slide, I wanted to share some information about how we engage with the emerging manager community, but I also thought it was worthwhile making sure that folks understand our definition. The NEPC definition is slightly different than LACERS, and then I'll talk about how we apply LACERS definition in a moment. But for our purposes, our research team, we look at diverse ownership and diverse led firms. So our definition of diverse owned is any firm that where 50% is owned or greater, owned by an underrepresented group. And you can see what we've identified as underrepresented sort of in the middle of the page there. We also look at firms that are diverse led, and that is where ownership is about 33% up to 50% from an underrepresented group. And so that's our definition when we're looking at the emerging manager community. And there's several ways that you can engage with our research team and with NEPC. One, we host an annual equitable manager participation workshop where we invite managers to come in and meet with our research team, understand our process, what we're looking for, etc. There's another way that we engage, and it's what I would call our Explorer program. It's relatively new, but we found that if we make it easy for emerging firms to engage with our research, then we've increased our knowledge base, but also the inclusion of these firms. And so any firm that meets our definition of emerging manager, if you send your strategy information into diverse managers at nepc.com, we take that information, we streamline it, and we will evaluate the organization and provide feedback pretty quickly. And so that's probably your best way of getting into our research team. We also have our standard due diligence process that we use, and then obviously client-directed searches. And so that brings me to the next slide in terms of what we do for LACERS. We do use LACERS definition of emerging manager, and I saw in the chat that there were some questions about the size of the firm. Brian did say 50 million. It may have sounded like 50 billion, but it is 50 million. And so those minimum qualifications for any search that the board establishes, that's really our starting point for when we receive proposals back in. We're focusing on those qualifications and making sure that firms meet those qualifications. And any firm that does meet that qualification, they have submitted a due diligence questionnaire, and we do read every single one of those for firms that meet the minimum qualifications, and we apply the metrics that is outlined in LACERS investment policy to evaluate those questionnaires and evaluate the proposals. 70% of that is qualitative, 30% of it is quantitative. And on the qualitative side, we're focused on the organization and the people. We're focused on the investment process and the risk management. And there are a number of questions in that due diligence questionnaire that are designed to give us a flavor for how each of the proposals, how the organization fits in and the people fit in with the process and the risk management piece. My recommendation is that when you're filling out that due diligence questionnaire, to be and use as in simple terms as possible, give us an indication of exactly how all those components fit together so that we have a really, really good understanding of those different areas within your organization. Again, we're looking at the organization, the ownership, how you might fit into a larger organization if you're a subsidiary of something, or the people that are managing the firm, the product, etc. And then the investment process, how those people fit into that process, or how you've got individuals that will fit into your risk management process. So that is what we focus on when we are evaluating proposals and scoring them on behalf of LACERS. The last slide here is just the investment team that works directly with LACERS. Again, we are all located on the West Coast. And if you've got questions about how to get into NEPC and you meet our definition of the diverse managers, my suggestion is that you submit material through that website or that email address of diversemanagers@nepc.com. If you don't meet that definition, but you certainly meet the definition that LACERS has outlined, my recommendation is that you contact me directly and I can get you in contact with the appropriate research person. You're also welcome to contact the other members of the team. Thank you.
Thank you very much, Carolyn. So now in the remaining time, what I'd like to do is open up the Q&A. And how we're going to approach this is that I'm going to address some of the commonly asked questions that were submitted during the registration period. And if you had submitted a question and those don't get answered today, what we'll be doing is posting answers to all of the questions submitted during the registration period or through the chat on the Emerging Manager Symposium page of the LACERS website. So the first question I have here was a very common question, and the firms asked, do you prefer that managers contact you or the consultant? So I want to start off by saying that LACERS has an open door policy when it comes to meeting with emerging managers. And we encourage you to reach out to us to set up meetings. And again, if you'd like to do that, you can contact the lacers.invest@lacers.org email address, and your request will be routed accordingly. And that's an actively managed email address, so don't worry about that message getting lost. That email inbox is checked several times a day. So we can assure you that you'll get at least one meeting with us, and we'll be honest with you as to whether we think your strategy is a fit or not. But even if it's not, we definitely want to maintain a relationship with you, as our portfolio needs change over time. And what's not a fit today may be a fit tomorrow. So we definitely like to maintain relationships with you. Carolyn, do you have anything to add from the NEPC side?
No, just that if someone is having a difficult time figuring out who the appropriate person at NEPC, I would just suggest that you contact me. I can get you in touch with that individual and make that introduction for you.
Great, thank you, Carolyn. Okay, the next question is, in which asset classes does LACERS allocate funds to emerging managers? And if you're unfamiliar with our policy has a no less than 10% of assets allocated across the entire portfolio. So what that means is we're looking to allocate to emerging managers across every asset class that we're invested in. And our policy stipulates that 10% goal, as well as a reporting mechanism to our investment committee and our board as to how we're progressing towards those goals. So we're as staff held accountable to trying to identify high-performing emerging managers to put into the LACERS portfolio. And the symposium is one way that we're doing this. So we encourage you again to reach out to us if you have other questions about our program, our process, our policies, or you just want to introduce your firm and tell us more about your strategy. The next question that was submitted asks, does LACERS emerging manager policy have a graduation clause, and how does that work? So unlike some of the other public pension funds, our program doesn't have a graduation policy or provision within it. So once you're hired into the LACERS portfolio as an emerging manager, we're really in it for the long run. And as long as your strategy continues to perform in line with our manager monitoring policy, which sets out various criteria related to performance and organizational changes. As long as you're in compliance with that policy, you'll continue to remain within our portfolio. And we've had a case where we hired an emerging manager back in 2013. And at that time, we had funded that manager with about $33 million in assets. And the manager had just continued to perform well over the years and now manages just under $300 million for us. So again, as long as managers are performing, we have a preference to keep them in the portfolio and give them opportunities for managing a larger portion of LACERS assets. Okay, next question. What occurs during the due diligence phase of LACERS manager search process? And I think really what this question is asking is, what is LACERS evaluating when they meet with emerging manager firms? So there are really two primary activities that occur during the due diligence phase of a search. The first is on-site due diligence visits with the firm. And that's often conducted with staff accompanied by NEPC, where we meet with all of the key professionals of the firm to assess whether any material business or investment risk exists that might put LACERS assets in jeopardy, and how the firm is identifying and addressing those risks. It's really about risk management. So for instance, if there's a small firm with 5 employees, all of whom are responsible for managing the portfolio and various aspects of the business, then we want to know how the firm is addressing issues like business growth and the need for staffing, succession planning, employee retention, segregation of duties between portfolio management and compliance, which is a conflict that we often see with smaller firms where either the portfolio management team or the traders are also handling the compliance function. So we want to know how you're addressing issues like that. With the reference checks, we're really trying to understand what issues current and previous clients have encountered with the firm and how those were resolved through client satisfaction. We're really expecting to invest firms for the long term, and we want to be ensured that the business is being properly managed for the long term. What is the most challenging aspect to investing with emerging managers? And I'm going to address this from the public markets portfolio perspective. So as you might have understood through my conversation today and Rod's discussion today, we have really limited opportunities to go out to the market and conduct RFPs. Really, manager searches are driven by a couple of things, either asset allocation changes, which we do every 3 years, or the need to replace current investment managers, which probably happens less than every 3 years. So our issue is trying to identify ways to maximize outreach to all of you so that ultimately we can get you to respond to our RFPs. And that's why I had given out a list of tips that you can do to help us in terms of outreach, and to be able to know about RFPs that we put out into the market and to be able to respond to those RFPs. Because we definitely would like to see a higher response rate from emerging managers to our searches. In prior searches, I would say the typical response rate from emerging managers would probably be in the less than 5% range. And to the extent that we can get those numbers up, we'd love to work with you on that. Okay, the next question is, what is the most common mistake you see with firms seeking to participate as emerging managers in LACERS searches? And really the most common mistake we see when we evaluate RFPs is that it's clear that firms don't really understand our emerging manager policy and how LACERS defines emerging managers. If you do happen to qualify as an emerging manager within our searches, that does afford you some modified hurdles to get your foot into the door. And oftentimes what we see are firms who think they qualify as emerging managers for our searches, but really are not when we apply the criteria. And that's unfortunate because we know that it takes a lot of your time and resources to complete these RFPs. We know that we ask for a lot of information and there's a lot of forms to fill out and probably several days worth of work to complete and submit one of these responses. So we just want to be clear and get the word out there of how our policy works and what our definition is to help firms avoid those mistakes of thinking that they're emerging when they're not. And in certain cases, that has led to the elimination of those firms from our process. So we want to be transparent with our policy as well as our process. Okay, I'm going to take one question here from the chat because I think this is interesting. And it says, EMs often don't have the dedicated staff resources as established firms to complete dozens of RFPs and RFIs. Has LACERS considered ways to work with other allocators to do combined searches for certain information? And no, we really haven't thought about that. What we do is we do speak with our sister plans at Fire and Police and the Department of Water and Power. And a lot of the information between our RFPs and their RFPs are similar because there are certain city requirements that we're required to include as part of our RFP searches. So in some ways, it's streamlined between the three plans. But in terms of working with other larger organizations, we tend not to do that just because our plan and the city have very specific requirements, and it's very difficult to incorporate those requirements when you work with other plans who may have different requirements. But a very good question. Okay, another very interesting question from the chat is, what do you believe are the biggest barriers or challenges, and what changes do you think have been made to increase more emerging managers to respond? And this pertains specifically to our RFPs. So the symposium, so we recognize that outreach can be better in terms of how we approach the market and how we let the market know about our RFPs. This symposium is one of the resolutions to that issue. And as you've heard earlier, we've had a number of attendees between the last symposium and this one, so that's great. The other things that we're doing is what I discussed earlier. So LACERS has a new LinkedIn website and social media initiative. And as our investment division, what we're doing is putting out more news about what we're doing and what RFPs we're issuing to the market on that LinkedIn website. So again, if you have a LinkedIn account, please follow that. Some of the other things that we're doing and have been doing are working with emerging manager focused organization, like the 3 organizations that I discussed earlier. But those aren't the only organizations. So there are a couple of others like the investment the Investment Diversity Exchange, Tide, who we've connected with to help us advertise our RFPs in the market. And we're certainly open to hearing what you think, what the best ways are to outreach to you, given that a lot of emerging firms have a smaller number of resources and may not always be looking out for our RFPs. So we're open to taking any suggestions that you might have. Okay, I hope that you found this information to be informative and useful. Should you have any further questions or would like to schedule a meeting, please don't hesitate to reach out to us. I'm now going to turn the agenda over to Wilkin Lee to begin the private market session of the symposium. So Wilkin.
All right, thanks very much, Brian. Good morning and good afternoon, everyone. Nice to meet you all virtually. My name is Wilkin Lee, and I'm the Director of Private Market Assets here at LACERS. So I've been at LACERS for 8 years now, and I lead up the team that handles private equity, private real estate, and private credit. I have 3 other investment officers on my team, and they are Eduardo Park, Robert King, and Clark Hoover. They meet quite often with emerging managers, so don't hesitate to introduce yourself if you're reluctant to them. So what I intend to do next is discuss the policy and process of private market commitments at a high level. Rod did a great job going over the state of emerging managers here at LACERS and our recent commitments. What I plan to do is cover how emerging managers fits into our overall portfolio and how we're able to commit to emerging manager funds in the context of our policies. Within each of the private market asset classes, we handle our commitments slightly different. We have it structured from a governance perspective where we can quickly commit to funds where there are short fuses. And in cases where we have more time, we have the investment committee and board involved in the decision-making process. In terms of the exact emerging manager criteria, I won't go to the specific details since we did that during our initial symposium last year, but I encourage you all to go to our website where it goes over each and every single item. The investment policies are located on the board tab of lacers.org. For the private equity asset class, where most of our emerging manager commitments occur, we have a streamlined selection process that allows staff and consultants to approve commitments within policy guidelines. LACERS is able to commit to funds without board approval if there's concurrence from our consultant and staff for funds up to $150 million. Now, this is a huge step up as our previous policy required board approval if it was more than $50 million for a first-time commitment and $100 million for a re-up. We're fortunate to have our board support in increasing the dollar amount, as this makes us more nimble to capitalize on opportunities where we see an appropriate fit. In terms of the background of our private equity portfolio, we've been investing in this asset class since 1995. Right now, we have a very seasoned portfolio that has a fair market value of around $4 billion. This consists of around 300 partnerships and 150 general partner relationships that are well diversified geographically and by strategy. We have a target allocation of 16% to this asset class. And for calendar year 2022, we're looking to deploy between 1 and 1.375 billion in private equity commitments. Now, the good thing for all the emerging managers listening today is that per our policy, our goal is that we commit no less than 10% of our annual commitments to emerging managers. So that translates to a goal of at least 100 million of capital that goes along towards you all in conjunction with our core managers. In terms of bite sizes for our emerging managers, we typically deploy between 10 to 30 million per commitment. For private real estate, we go through a closed session process with our investment committee and board, where they have the chance to interview the prospective GPs and determine the overall fit. In our private real estate portfolio, we have around 40 commingled funds that are broken out between core, value add, and opportunistic strategies. And our real estate market is around $1 billion right now, and our commitment sizes for emerging managers typically go up to 35 million per fund. For private credit, we currently have 3 fund of ones that serve as our core allocation with senior secured unleveraged strategies that focus on the US and Western Europe. We're currently looking for a dedicated private credit consultant. But once we have the consultant on board, we'll be looking to commit more capital on the non-core side. Our target allocation is 5.75%, and we have yet to determine our target buy size for private credit emerging managers just yet. I encourage you all to stay in touch with us, and we'll have more clarity in the 3rd or 4th quarter of this year. Given that LACERS expects to place no less than 10% of its capital with qualified emerging managers, that provides a great opportunity for us to work with you all and our consultants. In addition, we speak a lot with our other pension pairs and share notes about the emerging managers that we're looking at. Right after this, you'll have the opportunity to meet with Axia and Townsend and find out how they work with us in committing to emerging managers. The most important thing to do is to get your foot in the door, is to establish a relationship with us and our consultants. That way we know who you are and what strategies your firm specializes in. We're all slowly starting to resurface at the usual industry conferences, so don't be afraid to say hi to us or drop us a line. This Emerging Manager Symposium is a great opportunity for us to reach out to you all, and conversely for you to understand what LACERS is all about. So with that, I want to thank you all for listening, and I'll pass it over to David Phan from Axia, and he'll go over the consultant role in the investment process. Afterwards, Che Hong and Felix Fells from the Townsend Group will present. And finally, I will address some of the Q&A that we received in the registration process. So with that, I will pass it off to you, David.
Thank you, Wilkin. And greetings to everyone that's attending today. Let me start by commending the LACERS board and its executive director and chief investment officer and staff. Our success in emerging manager programs is really a function of the tone at the top. And LACERS as organization has really demonstrated that. There's a significant commitment from the top that percolates throughout the organization. And I can attest as their consultant that they are extremely committed to the success of our emerging manager program. Let me turn to the next slide. So I wanted to share a little bit about Axia. We have about $265 billion of assets under advisement. This is non-discretionary assets. And there's $17 billion of discretionary assets, about 100 clients globally. We have 7 offices covering the globe and about 370 employees. We've been also actively covering all managers in the alternative realm, including hedge funds, private credit, private equity, and real assets. So while our engagement with LACERS is just primarily on private equity, our firm covers a wide gamut of alternative investment ideas, and we welcome emerging managers covering all of those asset classes that we cover. Let's go to the next slide. We believe that a successful emerging manager program requires deal flow. And so we spend a lot of time trying to find you all, folks that are raising first, second, third time funds. We also spend a lot of time in the diversity, equity, inclusion space. We are active participants in SEO and Robert Twigo Foundation and AIM, NASP, NAIC, New America Alliance. We believe engagement is critical for us to find you and to learn about what you're trying to do and what you'd like to do. It's critical for us to really have a good discussion with you all. And so we welcome all forms of engagement. And we also spend a lot of time trying to develop and cultivate managers so that they are successful. Let's move on to the next slide. Now, this graphic really illustrates our investment process. We spend a lot of time with our with opportunity sets vis-a-vis a due diligence program that includes a questionnaire. For those that are raising capital, I think if before you actually go and engage a consultant like ourselves, I would recommend you go to the Institutional Limited Partners Association website and download their questionnaire, because their questionnaire is probably 60 to 80% of the things we would be asking for, and it would give you a head start in understanding and appreciating what we might be seeking in the private equity process. We also spend a lot of time reference checking. So as you think about raising capital, make sure you have a fulsome set of references that could speak to your qualifications, your skill sets, your knowledge base, and your track record. And maybe the last piece I'll focus on here is about track record. A lot of what we're looking for are proof statements, things that you've done in your past that could be validated to show that you could execute on the strategy that you're proposing for the fund you're raising. Let's move on to the last slide here. Our organization is really broken up into 3 components, and the portfolio advisory team, those that cover clients like LACERS, spends a lot of time focusing on elements like portfolio construction. We have a dedicated team of research professionals specialized by asset class that whose job is really to understand everybody in the marketplace and to find all the issues and attributes related to you all that could help us make qualified decisions about your ability to execute and invest successfully. And I think all this translates into client initiatives where we work closely with clients to figure out what the best portfolio fit might be for their private equity program in this case. And I want to go finish up with the last slide if we could. Now, this is the coverage team of LACERS. We are welcoming of all ideas. And so we believe in an open door policy. Feel free to email any of the three of us on this deck. My colleagues, Trevor, Jeff, and myself are all receptive to receiving fund proposals that might fit the LACERS program. Welcome, let me stop there and turn it back to you.
Okay, great. Thanks very much, David. I appreciate that. So what we do next is we're going to hand it over to the Townsend Group, who's our real estate consultant, and I'll hand off to Che Hong and Felix Fells.
Hello, everyone. To give you a brief introduction, my name is Che Hong. I'm a partner here at the Townsend Group. I'm going to give you a real quick overview of who we are, and I'm going to turn over to my colleague, Felix Fells, to discuss in detail our underwriting process. If we go on to the next slide, this slide here shows you a real quick overview. Townsend Group is a real estate investment consulting firm. That's all we do. We have a global real estate presence with 6 offices and 119 investment professionals. I myself, as well as Felix, we are housed out of the San Francisco office up here in the Bay Area. We have a very diverse institutional client base of approximately 138 billion in advised assets under consultation, with 21.6 billion in assets under management, which is our discretionary OCIO practice. We've been fortunate to be LACERS real estate investment consultant since 2014. And real quickly, what we do in terms of our scope of services, it's a very broad range. We start from the high level, top level strategic planning in terms of how to map out their real estate investment portfolio, as well as we do underwriting and due diligence. Lastly, before I turn over to Felix, like David mentioned with regards to Axia, we also have a wholly dedicated group to underwriting and doing manager research and really uncovering those managers that give us high conviction ideas that we pass along to our clients. So with that, I'll turn over to Felix.
Great. Thank you, Che. If we could move on to the next slide, I will just spend a few minutes talking through our firm's due diligence process, really going through how a fund is evaluated and can ultimately end up being recommended to LACERS or our other clients. So first of all, our due diligence team screens hundreds of fund opportunities a year, and the screening process includes several steps. So really to start, we ask for fund managers to send us their pitch book and any other available offering materials to a centralized email group that we'll share at the end of this presentation and that you'll also be able to see on the website. And in the initial stage, after we receive those offering materials, we'll make sure a fund is added to our internal database. We'll ask a few additional questions in an initial online due diligence questionnaire, really just some high-level questions to help us categorize the opportunity appropriately and help our due diligence team in their screening process. After all information has been received, our due diligence team will look at any fund that has been added to the system and screen for some high-level information, fit with our house views or fit with any specific client interest for the market sector or the region that the strategy is focused on. And then once information has been reviewed, our team may reach out to schedule introductory meetings to learn more about the opportunity. If after this initial screening process and a potential meeting, there is interest to dive into deep due diligence, then the fund will move forward to the underwriting stage, at which point we request a more comprehensive due diligence questionnaire and also assign an underwriter. That next step, can take several weeks to several months to complete, depending on opportunity. But throughout the stages, we really try to dive deep into the platform, the team, the strategy, track record, if there is any ESG factors, and so on. And we will ultimately determine whether this opportunity may be more appropriate for certain clients than others, or if it's something that we would like to broadly recommend to our client base. If a fund moves through the process successfully and ultimately is approved by our investment committee, we then share the due diligence report with LACERS and any other clients and discuss portfolio fit. LACERS also regularly receives a list of funds we're actively underwriting or that have been approved, so we make sure to discuss any of those names, even if something's not officially recommended to LACERS. And if the final verdict throughout this process is that the fund is not a good fit, we will still continue to track the manager and continue our conversations. We really want to make sure we keep an active dialogue and monitor any progress, provide feedback along the way, even if LACERS or our other clients are not moving forward with this opportunity at the time. That wraps up our due diligence process. So I'll just make a few more comments on the next slide on how we engage with emerging managers. We're not, even if we're not conducting formal due diligence, we're always looking to get to know new groups. We're attending several emerging manager conferences and industry events. We partner with different organizations that focus on emerging managers, and we use our various sourcing channels through our network of industry partners. So we often get referrals from both clients and other groups we've partnered with in the past, and we keep an active pipeline of emerging manager candidates. Even if we're not underwriting a fund, we still want to make sure we know what's out there and what might be an interesting fund opportunity down the road. We have conducted full due diligence on over 200 emerging managers over the last 10 years. And for LACERS specifically, since the consulting contract start date in 2014, 25% of LACERS non-core commitments were to funds sponsored by emerging managers. Lastly, we do our best to share any feedback along the way. We monitor thousands of fund positions across our clients, so we can share industry best practices and help you get to that next institutional level. On the last slide, if we move on one more, we show our email address here. That's the centralized email group I mentioned earlier. Our due diligence team will look at all materials that get sent here. It's townsendduediligence@aon.com. And with that, I'll turn it back over to Wilkin Lee, and we can answer any questions in the Q&A section.
Okay, perfect. All right, thanks very much, Jay and Felix. So what I'd like to do next is to go over some of the Q&A that we received during the registration process. We received a lot of similar questions, so we try to group them all together in the interest of time. So what I will do is ask a question, and I'll pass it off to David first, and then to Felix and Jay afterwards. The first question I have, or at least the participants have, is what are the primary attributes of an emerging manager that makes one stand out from the crowd? David?
Right. So obviously, the history and track record of the team is critical. We spend a lot of time trying to figure out the strategy and whether the team has the experience to execute on it. I think the other differentiator that is probably critical for us and probably all consultants and all investors is whether the firm is of institutional quality. And that means more than just having the ability to invest capital, but it includes elements such as the ability to manage risk, to think about building what could be a successful entity, including having compliance, a CFO function, LP reporting capabilities. So I think the assessment is multidimensional and really trying to determine which firms are going to be able to be there for the next 10 to 20 years and have that mindset.
Okay, I'll pass to Felix and Jay.
Yeah, it's basically very similar to what David mentioned in terms of what we see and what we observe. I think the most important thing also is understanding focus and patience, right? Private markets in general, especially real estate, success is not overnight. This relationship that we have with LACERS is a long-term relationship, and similar to our emerging manager as well. And just because a commitment doesn't come down the road the next day, that doesn't mean a year or 2, 3 years from now that a really solid relationship cannot start. So I would say the emerging managers that are out there are very successful, understand to be patient, and as well as persevere over that time, because those are 2 critical elements you're going to have in order to be successful in this business.
Yeah, I think from my perspective as well, I always find the story of the emerging managers very interesting. In this day and age, we obviously have a lot of folks who do the same type of strategies, but sometimes when we hear the story of the founders, I find it particularly interesting. For example, when we spoke with Miriam, she has a tight network of Stanford VCs and incubators. I thought that was a very compelling story. So I think things like that, from an LP's perspective, makes things stand out versus the other GPs that we meet. Let me go on to the next question. What are the common shortcomings you see in emerging managers? In your experience, what are the biggest hurdles for seasoned investment professionals raising their first, second, or third time funds? David?
I think the common shortcoming is when they choose not to invest in the growth of the organization, adding resources as they decide to scale, analysts, associates. So really building out the organization. I think the other shortcoming is, maybe the biggest risk for emerging managers is the team cohesion aspects, the ability to get along. And in fact, I think most emerging managers that don't make it to a second or third fund it really typically relates to partnership disputes and maybe the lack of ability to sustain some hardships. And so I think maybe we're looking for kindred spirits, people with alignment and the ability to go through rough patches as a team and survive those rough patches.
Townsend?
Well, for real estate, I would say, along the lines of what David said of, not investing in the team. I think just trying to grow too quickly or raise too much capital too quickly, with, while skipping a few steps in the process. So really scaling thoughtfully, starting with a smaller investor base, friends and family money, maybe some high net worth, rather than going in immediately to the institutional landscape, because the requirements change a little bit as the organization grows.
No, I definitely agree with that. We're also seeing kind of a lot of GPs dabbling in numerous strategies from equity to credit, and it seems like sometimes the story's not there. So we definitely want to make sure that they're at least consistent with their approach and not necessarily dabbling in things that are kind of outside of their expertise. I know David touched upon this during his earlier presentation, but how do you evaluate a new firm's track record, right? From what we're hearing is that, a lot of GPs who are spinning out, they're having a lot of trouble obtaining attribution from their prior firms, And how do you all deal with that, given that some of this information may be a little bit messy?
Yeah, it's a great question and one we are frequently confronted with. If they're spinning out from firms that we've underwritten in the past, XYZ spin out that, where 2 or 3 partners might be leaving a much bigger firm. And we've had the benefit of having assessed that bigger firm's performance and track record and gotten good sense of attribution. That obviously is the easiest scenario for us to deal with. And be able to triangulate vis-a-vis the information. Sometimes general partners might be coming from several different firms and don't have clear attribution. We spend a lot of time reference checking with CEOs that they might have backed, other investors that might be in the same company, SEC filings if they've been on boards, to really get a good sense of what truly might be their deals, or deals that they might have worked on in order to try to maybe gerrymander a track record. And so we've, that's happened a few times where we've been able to successfully get comfortable with manager attribution, even though they didn't have formal attribution from their former firms.
Yeah, along that lines, attribution, getting the proper assignment for that is really key, because you can run into legal issues, right? Because spin-outs now become competitors of the others. Not to say there will be some agreements where the larger firm will be willing to give attribution. We've seen that occur before, and that's because they have a very collegial relationship and they're running with a strategy that is completely different and oftentimes complementary to the parent firm that team has left for. But the thing is, though, if you can't get that in the absence of it, then that's where bootstrapping comes, right? You probably have to, look at your own personal balance sheet and do deals yourself. But that being said, it's a long-term game. And so we have a manager that we've seen before. We certainly are confident that there is some level of attribution with that GP. But at the end of the day, it's like, okay, well, we're going to need more here. And so let's see what you're going to do in fund 2, or, your own personal investments, whether that's getting friends and family money together, investing. And again, it goes back to what I mentioned, which is it's a long-term game here.
Great, thank you very much. So can you provide some general tips to all the emerging managers listening right now in terms of successfully being able to fundraise and dealing with investment consultants?
Sure. I would say view it as a process, a relationship building process. We're seeing on the private equity side that a typical emerging manager is taking upwards of 2 to 3 years to raise their first fund. And so, obviously having your story nailed down, having the resources necessary to sustain a fundraise is critical. Making sure you have your validating statements or proof points that support the strategy that you're embarking on. And don't forget about the back office support necessary to launch a firm. I think within private equity, you have to be a registered investment advisor once you hit a $100 billion threshold. You have to have the CFO functions. You have to have maybe operational partners as well that are going to be able to add the value that could be a part of your strategy. So having all the resources lined up is important. And, for a lot of emerging managers, they don't always have the resources necessary to put those pieces in place, but at least have a plan maybe the architecture on how you're going to be able to pull all the elements to create an institutional quality fund.
And I can add a few things on the real estate side, but I'd say, first of all, we have partnered with a lot of emerging managers who were not necessarily in the market yet with a commingled fund, but who were just looking for deal-by-deal capital on smaller joint ventures or other opportunities. So, even if it's not potentially a fit for LACERS or other, large pension funds at the time, we have a very diverse client base with different needs, different check sizes. So, I'd say it makes sense to sometimes start small, look for some capital on individual deals, and use that to build your track record, build the relationship, build trust, to then go out and launch a full fund. In addition, we also see certain differentiating factors when groups are out there raising a first-time fund. Ideally, you can offer something to our clients that other groups aren't offering, or some way to improve risk-adjusted returns. So, for example, starting a fund with an existing portfolio of seed assets that investors can invest in rather than being fully blind pool, or offering other economic benefits to our clients that can help them increase their risk-adjusted returns.
Yeah, thank you, Felix. And I think that's a critical part from our perspective. We've seen a lot of situations, especially with Townsend assisting us, where we have seen pre-existing assets in the portfolio. It helps us underwrite, understand what the strategy is, and makes us feel more comfortable coming into the fund. So let me take the flip side of that question. What should prospective emerging managers not do in dealing with investment consultants? What are things that kind of make things very difficult to underwrite from your perspective?
The tough things to underwrite are, maybe the easy part. When people tell you things that aren't necessarily factual or supported by references, when the strategy keeps shifting and maybe the team members keep drifting in and out. So anything that doesn't suggest stability or commitment are red flags for us. And then I think what we all on the buy side worry about and are those that are constantly trying to force an answer or create artificial deadlines. I think all of those are complicating factors as well. And I think the last piece would be folks that don't necessarily respect the process. We can't get to an investment decision in a week or a month sometimes. And sometimes we want to see the emerging manager multiple times over a one-year time frame to see how whether progress is being made. So, I think really respecting the protocols and process that are just reflective of good business practices.
Yeah, and we would echo a lot of those sentiments. But it goes back to what I mentioned earlier, was in terms of focus, right? Staying consistent with whatever your strategy is, whatever your process is going to be. Some of the successful smaller managers or emerging managers out there really oftentimes can start off from the endowment and foundation world, right? And oftentimes what happens is those LPs can be very demanding in terms of staying the course on that focus. And that goes to the point of, some of these emerging managers want to become bigger. They want to become the next Blackstone. But oftentimes those initial LPs say, well, that's not why we hired you. That's not why we liked you. And oftentimes they will say, we don't want you to be bigger than 500 million per fund, even though the fact they want to diversify outside. So that's what I would say is like focus and consistency are key in terms of, staying close to what your original knitting was.
Well, and I would put one more footnote on this. Basically, I think investors want to back people they trust and people they like. And so if you took that simple framework of being thinking about what might make you likable and trustworthy, I think, and you're able to consistently apply that, I think that would go a long way in terms of creating a successful fundraise.
Great. Thank you very much. So we have time for one last question. So obviously right now we're in a very challenging economic situation with rampant inflation. We have the turmoil in Eastern Europe. What macro factors and trends are you all looking at in driving portfolio construction? And what are you all recommending to your clients at this current point in time?
That's a great question. If you took the extreme of some of the fears we have, possible recession, maybe stagflation, rising interest rates, deteriorating revenue, maybe supply chain challenges. It suggests that there might be a sea change in the current environment whereby value-oriented strategies, maybe distressed, maybe rescue financings might be a set of topical strategies that we would focus on as a pivot to the current portfolio. We've been in the longest bull market ever, and growth has been a key economic driver, value driver for all portfolios. And now might be a good time to invest in some contrarian strategies.
Yeah, the rising rates is the issue. You look at the 10-year treasury, how the speed it's gone in terms of the increase in that rate alone. You're looking at 30-year mortgage rates now at 5%. I was trying to rack my brain in terms of the last time I saw 5% there, right? Certainly, that'll result in higher cap rates, and there will be some pain in terms of valuations. So, but what we really focus on and in general with private markets is kind of that vintage year diversification. You can't always time the market. I couldn't tell you that we'd have a bull run in real estate for almost a decade. But the reality of it is we tell our clients, stay the course, stay the process, keep good vintage year diversification, and really in the long run, because real estate is very much a long term asset class, you'll be fine.
Okay, perfect. I think we ran out of time for our segment, but thanks again for your responses, David, Che, and Felix. That was very insightful, and I hope the emerging managers and audience were able to get a lot of valuable information about how we engage with us and also our consultants. So I want to transition over to the next segment of the symposium, which is our fireside chat with LACERS Commissioner Elizabeth Lee and one of our general partners, Miriam Rivera from Ulu Ventures. First off, I'd like to provide a bio of Commissioner Lee. Commissioner Elizabeth Lee has held a number of positions at the City of Los Angeles, where she deepened her commitment to public service, fellow employees, and the city. She's a finance specialist at the Office of City Administrative Officer in the Revenue Group. At the City Controller, Financial Analyst, and Reporting Division, she led the preparation of the city's single audit and comprehensive annual financial report and managed the open data, debt, revenue, and other reporting programs. She began her city career in 1996 in several city departments, including Department of Transportation, Airports, Community Development Department, General Services Department, and Building and Safety. Prior to her city service, Ms. Lee worked in the international banking, finance, and manufacturing sectors. Ms. Lee has earned the Certified Government Financial Manager certification and the Certificate of Achievement in Public Plan Policy. She's a proud business and finance graduate of De La Salle University in the Philippines. In addition, she is a director of the Los Angeles Municipal Accountants and Auditors Association, director of the Los Angeles Professional Managers Association, member of Women in Public Finance, the California Society of Municipal Finance Officer, and also served on the Government Finance Officers Association Online Financial Transparency Task Force. So with that, I will pass it on to Commissioner Lee. Thank you very much.
Thank you, Wilkin. Good morning. I'm Liz Lee, your host for the Fireside Chat portion of today's symposium. Joining us is Miriam Rivera, CEO, co-founder, and managing director of Ulu Ventures, who will be sharing her insights and experiences with us. In 14 years, Miriam has launched 3 funds, raising a total of $204 million, which, according to Forbes magazine, makes Ulu Ventures one of the largest, if not the largest, Latina woman-led vehicles. Among her many pursuits to give back to the community, Miriam is a co-founder, former co-president, and current board member of Stanford Angels and Entrepreneurs. She is also a member of Goldman Sachs Launch with GS Advisory Council, an initiative which aims to increase access to capital and provide resources for diverse entrepreneurs and investors. Let's welcome Miriam Rivera. Miriam, thank you so much for joining us.
Commissioner Lee, it's a pleasure to be here.
Well, let's get on with the program. Miriam, you have 4 degrees from Stanford, including an MBA and JD. Very, very impressive. Before we touch on your career, can you tell us a little bit about your background growing up?
I think when people hear that resume, they tend to think that it comes from a very big position of privilege. But my parents started off as migrant farm workers from Puerto Rico, and they worked the crops between Florida and New York State, where I was born, before becoming factory workers in Chicago, where I grew up. And through philanthropy, I was able to get scholarships to go to college and obtain those degrees.
That's amazing. So prior to founding Ulu Ventures, you had a very successful career as a corporate attorney, a strategy consultant at Accenture, then VP and Deputy General Counsel at Google. What motivated you to transition into venture capital? Can you tell us a little bit about your experience starting your own firm?
Yeah, so I transitioned into venture capital after building a career for a couple of decades at the leading edge of technology, business, and law. The things that I did were a mix of deal making, including working on the largest deals that Google did in its history, including multiple deals in the $1 to $5 billion range, and helping to build some of the first revenue generation self-service terms and conditions for our advertising products and advertising syndication products. And so I think one of the things that I learned from working in tech is that it's really good to be involved in something that generates revenue for a company. And one of the things that I think of doing with our startups is helping them appreciate that revenue is the best form of financing that you can have for a company. You have to build great products, hire great people, and bring capital in. And sometimes that means taking capital from investors like Ulu Ventures, but most importantly, and to be able to control your own destiny, you must be able to generate revenue. So I realized that I could transition that skill set into venture, in part because I had seen others make a similar transition from both my law firm and others within the VC community that had law backgrounds, because that had been an area that I practiced in. But it was really the desire to change venture capital and who had access to capital that really drove me to start a firm of my own. At the time I started Ulu Ventures in 2008, very few firms were investing in women or people of color. Unfortunately, I don't think that's all that different today. If we see, investments in women are probably under 2% of venture capital dollars, and similar for underrepresented minorities and other categories of underrepresented people. So that was really the passion, and then trying to bring an analytic approach to making investment decisions that I thought would reduce bias, which was what I thought really prohibited people from getting access to capital. Not their skills, not their talent, not their ability to build great products, hire great people, but who they were and the level of risk that people perceive that to create in building a business.
Right. Did you have any mentor that you could point to that really, helped you out along the process?
Yeah, I've had different mentors in both, the legal and startup career path that I had. I was a startup founder myself in the late 90s. We had a board that included people that served as faculty at the business school, the law school at Stanford, as well as a VC. And I negotiated as part of my offer to be the secretary to the board. So I learned a lot from those people. In my law firm, I had, a great partner, Tom Kellerman, who still practices with emerging companies. At Ariba, Gabriel Sandoval was the general counsel and a true inspiration to me as a first-generation college graduate, first-generation American to become a public company general counsel in his 30s. And then, of course, through the Kauffman Fellows Program, Susan Mason. So wherever I've gone, I've always tried to learn from people who are a step ahead of me.
Great. So tell us more about Ulu Venture strategy. How do you decide which startups to provide seed funding to? Do you have any preference, like Edtech or Fintech? Can you give us examples, a few of them? of
Yeah,
firms you have invested in?
Yeah, we have, we're a generalist firm, but about 20% of our capital is invested in Fintech, probably about 10% in Edtech. But the real underlying criteria for us tends to be companies that are IT driven and provide services to enterprise, or for whom enterprise relationships are critical in building their businesses. We have 3 public companies out of our Fund 1 currently, and they include Proterra, which is an electric bus company. They also include SoFi and now I'm forgetting the third one, Palantir. Okay, so that was Fund 1. And Fund 2, we've had a total of 11 different unicorns. And in Fund 2, some companies that you may have heard of include Guild Education, which has really done a tremendous job over the pandemic in helping people to career and re-career, and is working with employers to help reduce student loan debt and provide education for their frontline workers. We've also had BetterUp, which is another unicorn that came out of the Los Angeles area, and the team graduated from USC and included 2 sons of immigrants, one from Eastern Europe, one from Peru. And so that company is actually now one of the leaders providing of online mobile coaching and mental health sessions for US enterprise workers.
All right, so you kind of mentioned you have 3 funds, and I included that in my introduction. What kind of lessons learned did you gain from Fund 1 and applied it to Funds 2 and 3?
So Fund 1 was our angel fund, and it was not institutional capital. There was no other investors except my partner, Clint Korber, and I. We did everything. You know, we were kind of the investors, the CFO, the lawyers. And the good thing is we had a good background to be able to do a lot of the blocking and tackling on both the operational side and on the investing side. As we moved to Fund 2, which was our first institutional fund, one of the things that we were able to use was our background as limited partners ourselves. I had been on the board of Stanford University, and my partner had been on the board of Grinnell College. He had served for 16 years, and I had served for 5 years at Stanford, and had also worked with other boards there at Stanford. So I understood kind of the mindset of LPs, and some of the things that folks have mentioned today around things like stability and commitment. And my partner and I had worked together in a startup, and then we had worked together at Ulu for about 8 years before we actually institutionalized and sought outside financing. What we learned was that we really needed to up all of the operating side of the business. And over time, we have added a really strong back office, really great accountants on the audit side and the tax side, as well as, a leading law firm, Cooley, in our fund formation space. And not to skimp on building the infrastructure to support institutional LP and our reporting, because they want to see that stability. Also, in terms of commitment, each of our funds, we've made a 10% commitment in the GP, and we expect that to continue in our next fund as well.
So that kind of transitions to my next question. You kind of touched on it. And David of Axia and Che of Townsend mentioned the factors that determine whether a fund meets institutional quality criteria. So let's talk about what steps you took to get your fund to institutional quality, which you've kind of touched on just a while ago.
I'll actually say that LACERS and its consultant Axia really helped us in an unusual way. I remember Heidi Poon at Torrey Pines before they were acquired by Oxia, and joining Brian Fujitsu's team. And one of the things that she told us was that we should go and do the Institutional Limited Partner Association DDQ. And so we took that very seriously, and our team, our CFO, who's also a CFA, and myself and Clint Corver, we all spent about 200 hours going through and preparing the ILPA DDQ. And I think the main thing that helped us to realize was what limited partners that are looking for long-term relationships want to see in a firm, and what are the kinds of policies and practices and processes that they want to have in place. And that really helped us to develop a plan for hiring the right kinds of backgrounds within the firm, as well as, in terms of service providers that I mentioned. And so we went through a process to hire a back office that was more institutional grade than the one that we were using. And, we interviewed a number of different firms before making that selection, and doing a transition that involved, a quarter-long process to make sure that everything would jive between one system and the other. So, there were a lot of process changes that we went through as a result of the advice that we were given by Oxia.
Great. So let me transition to, your experience raising funds. According to a 2020 report from Women in VC, about 5% of VC partners in the US are female, and I'm not sure if that's still the same proportion. How do you see gender playing a role during a capital raise? And what gender biases did you see in the investment industry?
It's interesting to me because I've worked in tech and investing and the law, which are all pretty much male-dominated professions. And so I've been able to be both a minority in terms of race, as well as being a woman. And I would say that being a woman is actually tougher. And of course, that might be because, I had the 4 Stanford degrees. I never got the racial implication that I was unqualified to do my job, which I think a lot of minorities suffer from on a daily basis because of bias. But in terms of being a woman, when I first started to raise a fund for Ulu, I remember going to a leading venture capitalist who had built a firm. I'd served on a board with him. And he told me that I was asking him for both advice and also a referral to a foundation that had instituted an emerging manager program that I thought we would be perfect for, and that I knew was an LP in his fund. And he told me that venture capital was a young man's game. I thought that maybe he should have put the word white in there as well. But it turned out that I later met 2 young Black male-led firms for whom he had actually made that introduction. So I definitely believe that there is quite a bit of bias against women. When a professor at University of Santa Clara did research on 40,000 rounds using the TechCrunch database, and determined that regardless of one's education and regardless of one's exit history, that women entrepreneurs were always at a disadvantage in raising capital, and that the best thing that a woman could do was to not be a CEO of a company, but to be a co-founder. And that would be outside of Silicon Valley, because if there were women co-founders on the team, they would actually be able to raise less capital than in other parts of the country. So the
Very interesting.
biases are deep, and we are hoping to change that by demonstrating that nothing succeeds like success. We believe the opportunity is infinite. Our women and diverse-led companies are outperforming the industry in many ways. And we think that, you know, the proof is in the pudding when you actually make investments and watch them succeed. That will change.
You know, you've mentioned that you worked with Heidi Poon of Axia when they were Tory Cove. We made an investment within Ulu in early 2021, if I'm correct. Could you tell us how you began your relationship with LACERS? How did it ultimately evolve into their $10 million commitment to your Fund 3?
Well, I'll say that we probably started like a lot of people with a no-go meeting with Rodney June at a one of these kind of meet and greet speed dating type of events when we were too small of a firm to meet the criteria for the emerging managers, meaning we were under 50 million. This is when we were still an angel fund and had, you know, 3 million essentially of our own capital invested. And then in terms of the next meeting happened to be, again, with Rodney June. He gets out there. He really does go to emerging manager events. And I met him at Hispanic Heritage Foundation event for LPs and GPs. And then he was interested in Ulu, and pretty much before he left for LA, he met with my partner and I at the airport and helped us understand about the emerging manager program. And then we started working with Heidi Poon while they were going through the acquisition with Axia.
So you've raised $100 million, if I'm correct, with
We
Fund
raised
3.
138 million. We had a $100 million target in Fund 3, but we were able to raise 138 million, notwithstanding the pandemic, which was definitely caused delay, but fortunately did not stop the interest in the fund ultimately.
So you talked about working with Heidi and with AXA. What was your experience like working with them and also other private equity consultants? I'm sure they're not the only ones you've worked with during the fundraising process.
Yeah, we have now in Fund 3, we have 7 foundations and 2 pension plans and 3 bank holding companies, and a lot of them use consultants. And actually 3 higher education endowments as well that don't use consultants. So, you know, we have a real big mix of institutional LPs. The ones that use consultants, we really know that it's a very process-driven approach, and that they typically have a large checklist of meetings that they have to have, and even location-based meetings, operational due diligence meetings that go on for hours. And of course, you know, they almost always have a DDQ that they require. And the interesting thing is you do the ILPA DDQ, but everybody still needs their own. But the good thing is you have a repository in the ILPA DDQ, which is probably the most exhaustive of all of them, to be able to you know, modify and provide in the DDQs for the particular consultants. So the one thing I think we've learned is it's really helpful to get as much of that work kind of started up front and updated before, you know, before we even think about Fund 4 next, which would be our 3rd institutional fund. We will have a lot of that ready. You know, we actually do a PPM. We have done it for our 1st institutional fund, our 2nd institutional fund. We will do it for this fund as well. I think that helps us internally to get our strategy really worked out, to get people on board and understand what we're going to commit to our limited partners. And, you know, we'll spend time to update the ILPA DDQ and be able to have a data room available that gives people the opportunity to do the desk work that they're all going to require.
All right. So, what advice can you give our other emerging managers out there who are in the audience who are seeking public pension plan or other institutional capital?
Well, I'm going to give you some advice based on personal history, because I know that this is a really daunting process for a firm as you're making investments and you're typically small and your fee streams are small and you don't have multiple funds. And, this is a part-time job. You should think of it as you have a day job of investing and you have a part-time job of being an operator and also essentially a consultant that's doing all of this kind of work and shepherding all this kind of work of creating a PPM and DDQs, et cetera, and your deck. And my way of thinking about it is, my mother, to have coffee, used to have to grow coffee. She had to collect firewood. She had to go get water from the river. And I'm just glad that she didn't actually have to grow the sugar cane to put sugar in the coffee, because otherwise I could never say I work too hard. So, just use your own experience of hard work and realize that it is a big investment. It is a marathon to build a firm. I really never quite expected that it would be so long, somewhere in the order of 10 to 20 years if you're really going to build a legacy firm like we aspire to do, so that even after we're too old to do this work, we want to have this work continue, because we've seen it make a difference in the country in terms of who has access to capital. And we see the importance of managers of color and women, because they place more investments with underrepresented minorities and women, and we make a big difference. So when we did our own research between 2015 and 2020, 2/3 of the investments that were made in underrepresented minority founders were made by the 50 firms in the country that had an underrepresented minority manager as a founder. So it's a lot of hard work, but my mother used to say hard work never killed anybody.
And Miriam, you talk about how you want to invest with diverse entrepreneurs. How can you give us some stats, and how has that effort been for your firm?
Well, about over 80% of our entrepreneur teams have a diverse member of the team, and that includes underrepresented minorities, which would be Latinx, African American, Native American, minority, which includes domestically born Asians, let's say Middle Eastern, et cetera. And then in terms of immigrants as well as women. About half of our teams have a woman founder. About a quarter of our CEOs are underrepresented. And our performance, I think, is driven by the fact that we have this level of diversity, and that because this industry systematically overlooks and underestimates people of color and women, we have access to an infinite supply of talent.
You say you would advise our emerging managers to join industry groups, and are there any groups or organizations that they should collaborate with to get more exposure to potential clients? Are there any conferences that you would recommend?
Yeah, in fact, I tried to make a list of some of these things. So interestingly enough, one of the best ways that you're going to get referrals to clients, in particular institutional clients, is either from another LP in your portfolio or a manager that is working with a particular limited partner. That's been our best source. And also working in as an LP, if you're able to yourself over time, I think you build relationships with people like, the CIO of a foundation. For example, I'm on the board of a foundation. I'm the chief investment. I work with the chief investment officer as the chair of the investment committee for that foundation. And that person has a lot of contacts in the industry. So because of those relationships, we get referrals to people that think they may be interested in ULU. So oddly, volunteering for over 30 years has been a very good referral network. And then in terms of organizations and events, we participate in a lot of events like Women's Private Equity Summit, Women's Venture Capital Summit, the GCM Consortium, Culture Shifting Weekend, Hispanic Heritage Foundation events. I'm a Kauffman Fellow. I participate in their LPGP events. And then, networking within groups like Latinx VC, Black VC, and events like some of the women's oriented events. Those have been really good sources for us of meetings with limited partners.
Miriam, you're a member of the Goldman Sachs launch with GS Advisory Council. How's that experience been like in terms of expanding your network or, helping other, emerging managers or underrepresented minorities?
It's been actually a really great experience, and you never know. Sometimes you feel like you're going to be in a token position when you're asked to be on an advisory council. But for me, what I realized was that they were both making investments in GPs, and they were making investments in minority. In particular, this is oriented at underrepresented minority founders through an incubator accelerator that they were creating. And I do believe that when people are financially motivated, like Goldman Sachs is, they want to help identify the best companies that they could invest in. They want to identify the best managers. Then they're not going to treat it like a token effort. And some of the things that they've done that have really demonstrated good partnership include having events where, we actually just have one-on-one time with some of the senior folks there to give feedback about the program, some of the gaps that we see, some of the things that we want them to do in terms of events and sponsorships. And then they've also lent expertise to our firm. So there was a recent number of companies in our portfolio that were seeking to go public through alternative means, including SPACs. And those transactions are ones that Goldman Sachs has a lot of familiarity with. So they literally gave us access to some of the two top people in SPACs at Goldman Sachs to help educate us about this. And they even participated in our limited partner events for our AGM. So, for us, that's been a really strong partnership.
Great. Miriam, we're almost out of time, but I'd like you to share some last, anything else you'd like to share with us. I really have appreciated your advice and insights. So I wonder if you could share anything that you could, advise or impart to our emerging managers.
I want to say that this has been probably the hardest thing I've done in my career. And, I started working when I was 13 because I needed to, and because I was helping put myself through private high school. And this has been hard. And there are times I think when it's hard because I do think there's biases in the industry, and people that started firms before mine are, 3 times as big, I think, because they're male-led. And so, you have to have a level of humility and just commitment to this work that it won't be finished in my lifetime, but I will start something that I think can make a difference both for entrepreneurs, for other GPs that I work with as a mentor, and I have many mentees as well that are starting firms, and that this is something that will catch fire, and that it will change how entrepreneurs can help grow our economy, because we really need to invest in the diverse people in the country, because they're starting the most companies of any groups. And without them coming up to even just the average size of American businesses, we're losing ground. They're the future. Over 50% of the workforce will be Latinx, Black, and Asian by 2030, according to the Bureau of Labor Statistics. So there's no turning back. We need to move forward, and we need to move forward together.
Thank you. And, I really appreciate LACERS investment team in, helping us connect with Miriam Rivera. She's been an astounding guest as well as GP for us. So this concludes our Fireside Chat. Thank you so much again, Miriam, for sharing your insights, your inspirational story and experiences. Now I'll turn it over to Rodney June, our CIO.
Thank you, Commissioner Lee, for being such an effective Fireside Chat host. And thank you, Miriam, for spending time with LACERS and its hundreds of EMs who participated on today's Zoom call. Your many professional experiences and working with LACERS and Axia, ultimately led to Ulu's commitment. And we're so pleased that we've been able to partner with you. I knew when I met you about 4 years ago that something good would result for you, for Ulu, and for LACERS. And again, you are very well spoken. You represent the emerging manager community well, and you represent the females, the women who want to break into this industry. And I think you've given them a lot of hope and inspiration today. You are a luminary and a strong role model for all underrepresented populations, including women. And we hope that those who have been on the call today, all of the emerging managers, that you hopefully have learned something from Miriam's experience, which is quite extensive. For our audience participants, I want to thank you for attending. I know it's been a long, 2 hours, but we think it's been well worth your time to join us. I saw on the chat for Zoom the word transparency mentioned several times. We want all investment managers to understand that LACERS operates under full transparency, and we want you to understand how you can participate in that process. And I want to ensure that we give each firm a fair evaluation and honest feedback from staff and from our consultants as you go through that process. If we were not able to answer your questions in the chat today, we will be publishing the questions and responses and a recording of today's symposium on the LACERS website. And you'll find that on the Emerging Manager Resources page. I am now going to turn the program to LACERS General Manager, Neil Guglielmo, who will provide final remarks as he closes today's Emerging Manager Symposium. Neil, please take it away.
Thanks, Rod. So I'd like to start off by just thanking our board president, Cynthia Ruiz, for her leadership, and that of Commissioners Nilsa Serrano and Elizabeth Lee also for their commitments to LACERS, to our Emerging Manager Program, and for joining us this morning, as well as the entire Board of Commissioners, including those who could not join us today, for their leadership and their commitment in this area. Also, a big thanks, Miriam. Thank you. That was a very enlightening fireside chat with Commissioner Elizabeth Lee. It was great to learn more about you and what you've done to get to where you're at now. A great success, and I think a fine example for many of the emerging managers who are listening in to this morning. So really wanted to express my appreciation to you, as well as to Rod and our entire investments team here at LACERS, and then our consultant partners, NEPC, Axia Torrey Cove, and Townsend, for all the information that they've provided and their commitments to LACERS Emerging Manager Program. Also, a special thank you to Barbara Sandoval on our investments team. She's done a wonderful job of pulling all of this together into such a great and hopefully helpful symposium for everyone this morning. And then, of course, a big thank you to all of you, our attendees who joined us this morning for this symposium, our second. Looking forward to more symposiums and hopefully some in the future where we're getting together in person so we can actually get to see each other again and work more closely together. If you would like to reach out to LACERS, please reach out to LACERS via the links that we've provided or go to our website and to the webpage. You can also use lacers.invest@lacers.org. That email, our website is www.lacers.org as well. There's lots of great information there. Looking forward to seeing all of you at our next Emerging Managers Symposium. And before I let everyone go, if all the participants who have access to a camera, if you can turn your cameras on, I think some of us would like to take a screenshot of those who have joined us this morning for this meeting. So if everybody could turn their cameras on now, I'll give everybody just a minute or so to do so. And then feel free to take out your phone and take some pictures. And of course, don't forget, we will have the video of today's symposium posted. So if you missed any part of it or would like to go back and re-listen to what was discussed today, you'll be able to do that. Okay, so anybody else would like to turn their cameras on? I know we have quite a few participants today. All right, I see Felix and hopefully Jeff and Commissioner Serrano. Alela, you can put your camera on too.
Smile.
All right. Thanks again, everyone. Have a wonderful rest of the day and much joy and happiness ahead. Looking forward to meeting you and working with you for LACERS in our Emerging Manager program. Thank you so much. Have a great day.